Sometimes I am surprised by how I overlook the most obvious investment chances. We've been talking about many megatrends on this channel like AI, cloud storage, the infrastructure buildup and the energy transition. But up to now, I have never connected the dots. Because there is one very boring product that we all know and that is absolutely critical for all of these trends. I would even argue that not even NVIDIAs chips or ASML's EUV machines are as critical as the product of today's company, Prysmian. I am talking about cables. Optical cables, copper cables, and most importantly, the speciality of Prysmian, undersea and underground cables. Because we are in a connected world where the power needs to be distributed over whole continents and the data even between different continents. So in this video, I will analyze what Prysmian exactly does, how their financials and valuation looks like, and if now is a good time to enter a long-term position in this absolutely critical company. My name is Florian, this is Cashflow Maniac, thank you for joining me today. First, let's have a look at their performance. Over the last year, Prysmian could outperform the S&P 500 by almost 3 times with a performance of 62% compared to the already very good 24% of the S&P. This already shows that the company and their products are indeed generating quite a lot of interest amongst investors right now. Over the last 10 years, the difference is not that significant, but Prysmian could still beat the S&P 500 with 396% total returns compared to the S&P's 250%. When we compare it to the more appropriate Eurostoxx 50 and the Eurostoxx 600, where the company is actually included, the outperformance becomes even more impressive. Here, the company could outperform both indices very significantly with an almost 10 times better performance. But what exactly are they doing to achieve this kind of long-term outperformance? The Prysmian Group is the global leader for high-performance cables for high-energy transmission, telecommunication and industrial applications. The headquarters is in Milan, Italy, but the company operates in over 50 countries for industries such as energy, infrastructure and digital communications. Prysmian specializes in rather unique underground and submarine cables that are our global backbone for data transmission. For example, these are the cables that run under our oceans to connect different continents. Or the cables that run the electricity backbones of countries. And of course, such cables are significantly more complex and expensive not only to produce, but also to install and maintain compared to standard or overland cables. With these products, they are positioned in a very unique way to benefit from multiple global trends like the energy transformation, the electrification or the digital transformation. And this is where it already gets pretty interesting. Because they are not only in a prime position to drive many of these structural changes, of which we'll talk more later, they have also recently changed their internal structure to be better aligned with these different trends. In 2024, they have changed their formerly 3 divisions to the current 4 divisions: transmission, power grids, electrification and digital transformation. With this new structure as a first step, they are planning to transform the company from a traditional cable manufacturer to a provider of full cable solutions. They are aiming to not only sell the cables anymore, but to also act as a one-stop shop for all cabling solutions. This includes all steps from installation, that again, especially for underwater or underground cables, is not that trivial, to monitoring and maintenance of the whole infrastructure. And they are equipped in a very unique way to do this. For example, the company is operating their own small fleet of 5 cable-laying ships, including the 2 most advanced cable-laying ships worldwide, the Leonardo da Vinci and the recently acquired Mona Lisa. And they are currently in the process of further increasing this fleet. With these high-tech ships, their 140 years of cable-laying experience and even a dedicated marine base for maintenance missions, they guarantee repair and recovery times that are 70% faster than their competitors. And with the news of potential or tried attacks on the global undersea infrastructure accumulating lately, the ability to make speedy repairs become more and more important. And of course, the more cables are laid out, the greater the demand for proper maintenance becomes. And even though they are an Italian company that many people probably have not heard of, Prysmian is the global key player in this very unique field. In their last fiscal year, they generated the majority of their business, namely 54%, in the electrification segment, followed by their power grid segment with 22%, transmission with 14%, and 10% in digital solutions. But they are currently working on multiple areas to increase the business in the US even further. And one of this could very well be the catalyst that pushes the stock even higher. First of all, they have just acquired their US competitor Encore Wire last year to bolster their US presence even further and to expand their product portfolio to low voltage wires for residential, commercial and industrial buildings. And this is also not the first acquisition in the US. In 2018, they also already bought their competitor General Cables. So they are continuously expanding their footprint and their portfolio, and by doing so, they also eliminate their competitors. This again shows their very strong position here. And they are not slowing down. In their last earnings call, their CEO Massimo Battaini said that they are currently considering an acquisition of their rival Nexans industry segment. And just a couple of weeks ago in January, the company announced that they are currently thinking about a dual listing on the New York Stock Exchange. And I find this particularly interesting because this step could make the stock and the company much more visible to US investors and bring a lot of new attention to them. But these are just rumors and nothing has been decided yet. What are not rumors though are the general trends that drive the growth in this market. And these drivers are, first, the growth of renewables and the trend to electrification that both put quite a strain on the current energy infrastructure. Especially the continued trend and growth of offshore wind parks will push the need for undersea power cables. And this update of our energy infrastructure is also needed on the land. Prysmian expects that the investment in these grids will triple in the coming years. Last but not least, the continuing need for high-speed internet is also pushing the need for high-speed optical cables. All in all, the market for submarine cables is expected to grow by over 6% annually, while the market for underground cables is expected to be even above 7.7%. This doesn't sound too exciting at first, but it still means that the company is active in a steadily growing market. And these trends are not short-lived ones, but trends that should continue for years to come. And as I said earlier, Prysmian has a very strong position in this market and is currently able to further increase their market share with their strong presence as well as their recent acquisitions. That is also due to the very strong strategic position in this segment. Because of the high capital requirements, it is not so easy for new competitors to enter this market. And the long-term operation and maintenance contracts, especially for undersea cables, make it very hard for their customers to switch to different manufacturers. But because the customers are usually telecom, utility or big tech companies that all belong to the biggest companies in the world, they do have quite a strong pricing power. I still think that the company does have a significant moat, and their recent shift to a solution provider instead of a pure cable manufacturer can help them to bind the customers closer to them and also to build up a subscription-like revenue stream. And speaking of revenue, how did the company perform financially over the last few years? While we can see a bit of seasonality and fluctuation in their revenue, EBITDA and free cash flow, the general trend for all these metrics is pointing very nicely upwards. The free cash flow looks a bit strange, with the first quarter usually being negative, but this is due to several seasonal effects like harsh weather in the first quarter, payment cycles of the customers, or the preparation of the more active summer quarters in terms of inventory and materials. But the long-term year-over-year trend here is indeed also growing very nicely. When we look at the last 5 years, the company could grow their revenue by 6.9% annually, their free cash flow by 10.7%, and their EPS by 27.3% even. This is not only organic growth, but also includes the acquisitions though. What I find particularly interesting is that the backlog of the company is constantly growing. Here are the numbers as reported last summer, and we see that over the last 3 to 4 years, their backlog has increased dramatically. So the company is getting more orders than they can currently fulfill. This is also pushing their sales that, in addition to the acquisitions, is also growing organically. it also helps the company to reach and further grow their profitability. In the last couple of years, they could at least keep their margins stable, and in case of the free cash flow yield and EBITDA margin, they could even grow them further. That leaves the current free cash flow yield at an amazing 5.2%, an EBITDA margin of 8.9%, and return of invested capital of 8.4%. This is all a bit below the margins of the general industrial sector, but there are several reasons for this. First of all, they are investing heavily in R&D, particularly for high-tech undersea and optical cables. And second, as mentioned earlier, the cable manufacturing industry is one with high material costs and a significant competitive rivalry that increases the price pressure. Their balance sheet still looks okay, but we can definitely see the effects from the last acquisition. The net debt to EBITDA ratio that has decreased for many years since 2018 has now increased significantly again. And while the company has not bought back shares yet, up to last year, they have also not diluted their shareholders by much. This has changed last year though, when they did issue a bunch of new shares to help finance the Encore acquisition. This has brought the current debt to EBITDA ratio to 3.4 times, which is a bit above my usual threshold of 3 times. But I believe that this is only temporary and the company has already shown discipline in their cash allocation in the past. So I'd assume that in general, this will also decrease again. But there is also the potential for further increase in case of more acquisitions. In Market Screener at least, the expectation is that this leverage will decrease again over the next 3 years. S&P Global still gives the company a credit rating of BBB-, which is still investment grade, although just barely. And in their last annual report, the company also states that they expect that in order to support the backlog and further growth, the capex for the next 5 years will be roughly double the value that we had in the last 3 years. So there is a very real possibility that the company might not be able to pay back their debt as quickly as they did in the past. They are still paying a dividend with a current yield of slightly over 1%. But the dividend growth has been very nice in the double digits with 10.2% per year over the last 5 years, with a still very low cash flow payout ratio of only 21%. This leaves plenty of room for further growth if the company decides to do so. But despite this nice growth, the dividend yield did still decline steadily over the past 5 years. This emphasizes the great performance of the stock over the last 5 years again. And it also already indicates that their valuation might not be the cheapest right now. And indeed, the valuation is well above the sector median in all cases. The PE ratio is currently at 34, a third higher compared to the sector median of 25. The EV to EBITDA is at 13.4 compared to the median of 12. And only the price to cash flow is with 10 compared to the median of 14.4, almost a third lower, which again shows that the company is a real cash flow machine. The PEG ratio, that also takes into account the EPS growth over the next years, is with 4.1, well above the median for other industry companies. So investors have to pay a price for the market tailwinds and the strong position of the company. And of course, the market is always trading the future. So what is the expectation for the company going forward from here? The 17 analysts that give a 1-year price target for Prysmian have very different opinions. While the average price target is only slightly higher than today, the most optimistic of them expects an upside of 33%, while the most pessimistic thinks that the company will even decline by over 50%. So the expectations are quite different from one another. At least the EPS is expected to grow with a CAGR of 21% until 2027 and the revenue by 6.4%. This is just a little bit lower than what we had over the last years. Last but not least, before I sum this up and come to my conclusion, let's also compare them to some of their competitors. And if you find this video interesting and want to support the channel, please hit the like and subscribe button so the YouTube algorithm shows this video to a larger audience. I already know in advance that this video will probably not go so well because I am talking about a rather unknown company here. And most people only want to hear about the same growth stocks like NVIDIA over and over again. So one small click from you really helps me out a lot here. Thank you very much. So for today's peer comparison, I choose Nexans, the next potential acquisition target of Prysmian, Sumitomo Electric, Fujikura, and Belden. And from a total return perspective, Fujikura had the best overall performance with 480% total returns. Seeking Alpha also only provides the data for Fujikura from 2023 and later, which makes this performance even more impressive. Prysmian still had with almost 400% returns the second best performance in this group. The best dividend payers from this list are Sumitomo with 3% and Nexans with 2.6%. But Fujikura together with Nexans could grow the dividends the quickest with 15% for Nexana and even almost 60% for Fujikura. What you should know though is that Fujikura did previously cut the dividends and only started to pay one again in 2022. Valuation-wise, we already saw that Prysmian is quite a bit more expensive than the sector median. And the same is true when we directly compare them to their peers. They have the highest PE ratio and, together with Fujikura, the highest EV to EBITDA ratio. Only the price to cash flow ratio is sitting rather in the middle of the pack. But the long-term growth, and I'm looking at the 3-year and 5-year numbers for revenue and EBITDA, as well as the cash flow growth, are also at the top of the group, again, together with Fujikura. So, all in all, I think that the company has great potential from here. Even though their business, cables, is a very boring one, it is also a very necessary one that is benefiting from several global megatrends right now and should see some nice growth for years or even decades to come. I also like that their management has their investors in mind with their dividend payments and constant, long-term double-digit dividend growth. But I also think that the current valuation is a bit expensive and believe that it might be worthwhile to wait for a better entry point. Generally speaking, even though the company does have a moat and a very strong strategic position, they are still operating in a very competitive and also capital-intensive market. But if this doesn't scare you, I think that they will be a good investment, especially for long-term investors that are looking for high dividend growth like me. But in the short run, I would also not rule out a correction. This doesn't need to be a crash. The stock could also just go sideways, as the majority of the analysts seems to expect for this year. But if there is any news about a dual listing in New York or the next acquisition, this could also quickly go in the other direction. But this is just my opinion. What do you think about the company? Do you like them? Or do you have any concerns that I might have missed? Please let me know down in the comments. And this is no financial advice, so please, before investing, do your own research and only use this video as a starting point for your own analysis. And guys, if you are wondering if the recent crash in one of the most popular REITs, Realty Income, is a good buying opportunity, I have a video right here where I'll go over the latest numbers and the outlook for them. That being said, thank you so much for watching guys, and see you in the next video.